Dear clients, I'm Richard, Senior Phillip CFD dealer. Last week, US equity markets extended a rally in thin trading, with the small cap Russell 2000 rebounding to an all-time high alongside the S&P and Dow Jones 30, while the Nasdaq 100 also capped a positive weekly advance. As noted in my previous commentary, the recent outperformance of the Russell 2000 underscored the prevalent market consensus view that the US equity is withstanding the global slowdown. As a result, the US Small Cap Index, a key beneficiary of this investment theme, is playing catch-up with its larger cap peers. In fact, the Russell 2000 has made a handsome 16% recovery from an 11% correction that saw it slipping to a one-year low on October 13th. Now, keeping tab of the US policy and data front, Fed said it will be patient on the timing of interest rate increases, while the US GDP also expanded at the fastest pace in more than a decade. These US market developments provided the tailwinds for the continuations of the US equity bull run, already in its 6th year, overwhelming other global concerns that include a potential Eurozone recession, a China growth slowdown, or even a possible financial crisis in Russia due to the combined effect of lower oil prices and economic sanctions. From the cross-assets perspective, the greenback is also set to gain against all of its 31 major counterparts in 2014 for the first time in data going back to 1989, an anchor of an improving US economy, as well as in anticipation of the first US rate hike next year. Even the US Treasuries are on track for their best performance since 2011, as low US inflation, higher yields relative to other sovereign debts, and persistent global turmoil enhance the allure of the securities. Well, putting it all together, doesn't it seem like the US policymakers are orchestrating all the right moves and coming out on top of the US reflation game, i.e., bestowed with an upcoming US rate hike amid an improving US economy on the one hand, yet having well-behaved US inflation numbers and offering sovereign yield come safe haven appeal on the other. However, as 2015 approaches, and notwithstanding current risks on equity sentiment they may persist in the near term, I believe that the key trend to keep an eye on is the rise in market volatility from the unusually low levels that had characterized 2013 and the first half of 2014, driven primarily by the impending shift in the US monetary policy direction. In fact, since September's autumn market corrections, equity market gains have been accompanied by greater volatility, as measured by VIX, also known as the Equity Fear Index. It is worthwhile to highlight that the average daily close on the VIX, which measured approximately 13.5 in the prior period, has since risen to about 15.5 level. In addition, 2015 will also likely be a year of market contemplations between an overly optimistic global growth expectations based on the recurring optimistic biasness in the prior few years of the current market cycle, and further global reflationary efforts thanks to panicky policymakers from BOJ to ECB to PBOC. Given the above-mentioned tectonic market shifts, one should expect higher frequency of market setbacks and recoveries, which would translate to more good trading opportunities for the nimble investors. Clients may consider using Phillip CFD to trade equities and indexes across markets to capitalize on trading opportunities in both rising and falling markets. In addition, you may also trade based on different strategies using many more benchmarks, which are available with Phillip ETFs. With that, I've come to the end of the presentation. Thank you for watching this week's Market Watch. I'm Richard from Phillip CFD. Please subscribe to us on PhillipCapital YouTube channel and Facebook. Stay tuned for more Market Watch videos.